Let me start with our largest and also currently best performing business, which is our mining business. So we are showing very nice top line, but also bottom line growth that is mainly derived from business out of South Africa, in Central Africa, but our currently fastest growing market is Australasia. So that's definitely a highlight. Also the performance of our water business in both the mining water business, in the industrial water business is really performing very nicely, growing market. On the other hand, the public water business is a little slow in the moment. That's not related to market. That is because of weather conditions. This business depends a lot on rainfall. And also the local South African agriculture business is performing very, very nicely, specifically growing more and more our own formulated products over our traded portfolio. So I think that is really the highlights.
One of the things you pick up when you go through the financial statements is that you are seeing some margin pressure come through. For instance, when you look at your chemicals business, talk to me about some of the factors that have contributed to that margin pressure.
Yeah, actually, in the chemicals business, what we see is this is depending highly, first of all, a very local business, very South African business. So this business gets the full pressure of the South African macroeconomic conditions. It is a business that is much closer directly to consumers. So you see that reduced consumer spend is affecting the business also negatively. Then we had one large customer, Fosco, which had a plant shut down for almost half a year. They are recovering now, and we are back in business. So that was also one of the factors why the business is carrying high level of working capital, because the raw materials were already ordered, but the business with the customer was interrupted.
You embarked on a turnaround project for the German side of the business. What progress are you making on that front?
Yeah, actually, we decided last year to start a restructuring program that was approved. Since then, we are on course. Actually, the key change here is the closure of one of the 4 German sites to consolidate the production into the other sites, reducing cost. So that part of the project is running very, very well. So we are not facing any larger difficulties, nor disputes with customers or other stakeholders. So that's really going very well. What is unfortunate, so, is that these changes that we have initiated last year are rather long-term. That means the effects are not being visible more likely before end 24, early 25. And therefore, we also decided now additional measures that should drive short-term improvements.
One of the things you mention in your SENS statement is that you remain committed to furthering your BBBE goals. And you also have a line that says here that one option is to embark on a relevant employment strategy that takes into consideration the key learnings from the previous one. When it comes to those BBBE goals, I mean, what would you say were the learnings there that would make the next employee scheme a little bit better?
Yeah, actually, the problem was the way it was structured. So the connection with the share price and the fact that the business and therefore the share price didn't grow as it was expected, and that is how then in the end the EST vested without value. So we want to change that conceptually and also make sure that there is definitely a payout at the end of the period, actually with an upside, but the downside cover.
On the topic of the share price, since you've taken the helm, what's your perception of the market's view on AECI, if I may ask?
Yeah, I would say that everybody more likely would agree that currently the company is greatly undervalued. And that is, of course, for reasons. We are a conglomerate, we are relatively a large portfolio, and that has an advantage, and the advantage is that we are less vulnerable from specific downturns of specific segments. On the other hand, we are probably spreading ourselves sometimes too thin, so we are not always able to grow the core business as we want. And this is something, just to take that leeway, as you also mentioned, the strategy. This is something that we will address during our strategy work, to look into all the individual businesses and make sure and decide which ones are the ones to take forward, or which ones are the ones that we may not take forward.
On that note then, when it comes to the reduction of debt and your working capital, what kind of operational initiatives are you looking to embark on in order to strengthen that balance sheet?
Yeah, actually to start first, I want to really repeat that we are not concerned from a financial perspective with our current gearing level. We just don't like it because we are operating in a high interest rate environment, and so our financing costs went significantly up, and that's actually what we want to counteract. So we are taking three measures here. The one is reduction of working capital. So here it is about reducing inventory, which we have built inside of potential supply chain interruptions, specifically for ammonia. It is about also an elevated number of our receivables, so we will focus on collection. We also look and we will review the investments that we have planned for the second half, and really decide for those that are supporting our strategy and grow our core, and that deliver ROIC above WACC, so that we can create economic value add.